Hello traders, welcome to another episode of my video. So in this video, you learn what imbalance is. So and I will dive deep into how to spot the gaps and hidden imbalance on Forex market chart and uncover the opportunities they present. So you as well learn their causes, what actually cause the fair value gap in the market, and how to use them to make smarter trading decisions. What is imbalance in the market? So imbalance can simply be defined as the gap between three candles in the market. Gap between three candles. So you can as well call them the fair value gap. As you can see on the screen, you can call them imbalance, fair value gap, or inefficiency in the market. So this will cause when the demand or supply of a currency pairs are unequal, leading to imbalance in the market. So, and what actually caused imbalance? The economic data, the geopolitical events, and market participants. So now I'd like to break this down to you. How to spot the imbalance in the market. First example we have here. The first one, as you can see, when you look at this tail candle, when you take a look at this, the high, which is the wick, the high of this wick, when you mark it out, you also mark out the low of this wick. As you can see within this tail candle, you can see that the wick, the low of this wick and the high of this wick is not doing what? It's not mitigating. This low did not mitigate the previous candle. The top candle high here. This candle does not mitigate. So this is what we call imbalance in the market. We refer to as imbalance in the market. The main reason for this is that when you look at here, this low at the beginning of this of the first candle, anytime this occurs, this tells you that there is a very large demand at this point. So when there is large demand in the market, this leads to imbalances, and this is telling you that price will eventually come back to balance it, because this gap needs to be filled. Anytime price creates gaps like this in the market, it actually needs to be filled. So we can make use of this imbalance and make use of it as an additional confluence to our entry. So maybe you've done with marking your structures and your bias is to buy, and so you spot imbalance in the market, then you can as well use this imbalance as your entry confluence, as additional confluence for you to take your buy entry. But let me just say, sometimes in the market you see price coming back to fill this inefficiency. Yeah, sometimes you fill half of it, you see price filling half of it, and what happens is you see price just retracing from this point, and price will continue back to the upside. And sometimes price fill up even everything, you see price coming back to fill up all this inefficiency, and at this point price will do what? And price will continue to the upside. So this is the reason why I say we can use it as an additional confluence to our entry. So I like to label this as our imbalance. So you can call it fair value gap, you can call it imbalance or inefficiency. So it's still the same thing. So this is how to spot your, or let me just say, this is how to mark your imbalance in a bullish trend. The first example is a bullish trend, as you can see, and it doesn't matter even if the candle is green or the candle is red, that doesn't matter. So in as much we are having space within three candles, so that signifies imbalance or fair value gap in the market. And as you can see, the next example we have here, when you look at the low of this first candle, when you drag it out, you take your trend line and you drag mark it out the high of this third candle. You can see that we have a gap here. We have what we call the imbalance here between the first candle and the third candle here. We have imbalance here. So this is how to mark it out in a bearish move. And this is our what? And this being our second example. And let's look at the third example we have here. If you look at the third example we have here, this is also a bearish move. And if we take out our trend line and mark it from the low of this first candle, which is the wick, make sure when you want to mark out your imbalance, you make sure you are marking it out from the wick, not from the body of the candle. And if in a situation we have something like this in the market, maybe we have we don't even have, sometimes candle can even close without even a wick, or with small wick. Sometimes we have it like that. And if you want to mark out your imbalance in any kind of situation in the market, you will mark it from the low of the candle, which is the lower body of the candle, and to the third candle. It can also be the body of the wick. So that's how you mark it. When we draw our trend line from this point to this point, you can see that we have no gap in this situation. So you can see the wick here, the wick of the first candle and the wick of the third candle here mitigate. So we have no imbalance here. We have no gap, no fair value gap here. This being our third example. And as you can see, for our third example, we have no gap here. So in this kind of situation here, this tells us that this price here has already been mitigated. So everything here has been fulfilled. So in this kind of situation in the market, you can't count this as a fair value gap, because this low and this high has already been mitigated and everything here has been filled. And if you look here, the next example we have here, the fourth example, if you look at the fourth example we have here, from the low of the first candle, no, from the high of this first candle, to the low of this third candle, you can see we have no gap as well. Everything here has been filled, as you can see. So this is a fulfilled price movement already. Everything here has been fulfilled. In the third example we have here, everything here has been fulfilled. And the fourth example we have here, everything here has been fulfilled. And we have another example here. So in the fifth example we have here, as you can see, when you look at this candle, this is also a bearish move. When you look at this first candle we have here, and when you mark out the low of this first candle, when you mark it out, draw your trend line to the right side. When you mark it out, and as you can see, the second candle we have here engulfs these two candles. As you can see, these two candles are inside bar candle. As you can see, the high of this candle still inside the previous candle, and the low of this candle still inside of this previous candle. So all these are inside bar candles. And look at the this other candle we have here, the next candle here, the high of this candle, when you look closely, you see that the high of this candle is inside this previous candle, which we have here, this second candle we have here, and the low of this candle is also inside the second candle we have here. So all these candles are all inside bar. These are advanced way of spotting imbalance in the market. So most people don't recognize it in the market. So there are many traders who are not even familiar with this kind of traps in the market, because this is a trap, because the institutions create this in the market so that the retail traders won't recognize all these kind of gaps. All these candles, since they're all inside bar, all this space we have here are still gap. There are still gaps in the market. So if you want to mark your imbalance, then you make use of the then you draw or let me just say you draw the eye of the third candle here. So this makes your imbalance in the market, as you can see. Because why? Because this candle is not inside of this previous candle, but these two candles, they are all inside this previous candle, as you can see. So these two candles are inside bar. So this makes it a fair value gap imbalance in the market. I hope you understand. If you have any questions, you can write down in the comment section. And as you can see, this is a bearish example. The sixth example we have here is a bullish example. When you look at this candle, this first candle high, which is the wick, and you mark out the this candle we have here that is outside of this second candle. When you look at these two candles, you can see that the high of this candle is inside this previous candle, which is the second candle, and the low of this candle is inside here. And this fourth candle, when you look at it, the low and the high is inside this momentum candle, which is the second candle. So you can't count this as a breakout candle. These are all inside bar. So when you want to mark your imbalance, you will mark it from this high, which is the high of the first candle, to the low of the third candle. So this makes your imbalance. These are hidden imbalance in the market. Yes, they are all hidden. Only the advanced, or let me say the advanced smart money traders, can recognize this kind of imbalance in the market. These are hidden imbalance in the market. As you can see, I hope you understand. This candle break out of this. So let's just say this candle break out of this candle. Then this disqualifies, and this is no longer an imbalance in the market. Everything has already been fulfilled. But since we have something like this, since this candle is an inside bar inside of this second candle, so this becomes our imbalance in the market. And we have our third candle here. This third candle high is outside of this second candle. So now we have a clear imbalance in the market. So these are hidden imbalance. So here I would like to show the rechart example of what I've been explaining all this while about imbalance and fair value gap in the price or in the market. Let me just give you this tip. The best time frames to make use of imbalance as your additional confluences for entry are usually the higher time frames. Yes, the higher time frames is the best time frames to make use of imbalance as your additional confluences, because the reason why is that on these higher time frames, imbalance are more effective, because anything that happens on the higher time frames are more effective. Even the supply and demand on the higher time frames are more effective than the one you see on the lower time frames. Using imbalances on the lower time frames, you have very low chances that it's going to be that effective for you, or it's going to be helpful for your strategy or for your entry. Make sure you're making use of it on the higher time frame. So when price now fulfill maybe when price now come to mitigate your imbalance on the higher time frames, then you can also scale low to your lower time frames to execute your trade. So that's it, very simple. So if you want to spot out, let me just say we want to mark out our imbalance here. This USD CHF chart on the 4 time frames. As you can see, we have the first candle here, the second candle, and the third candle. Now between this first, second, and third candle here, when you take a look at this very well, you see that price has already mitigated. This third candle has mitigated the first candle, so we have no imbalance here. And now let's make use of this, the second one we have here, because we have a pullback here. This first candle, and we have another candle here, which is the second one, and we have another candle here that break out of this second candle, as you can see, because all these two candles you see here, they are all inside bar. These two candles, they are inside bar to this big candle. So if you want to mark out your imbalance, it will be from this low, from the first candle low here to this candle, which is the third candle that broke out of this second candle. So this is how you bring out your imbalance. As you can see, this first, second, and third candle has not yet mitigated. So immediately price just went down and come back here. This is when you start looking for your entry. And sometimes you can even make use of your opportunity, or let me just say you can even take trades on the higher time frames. Maybe if you are not that kind of trader who make use of lower time frames, you can even enter directly on the higher time frames by making use of this imbalance. So I'm going to show you everything in this video. So now let's just mark it out on the high of this third candle. So this is our imbalance. So now when you look at this, when you look at it very well, you see that immediately price went down at this point. After creating this imbalance, price went down here, and you can even see sometimes even at this point when you look at this point here, we even have price creating imbalance here also. Now let me see, from the low of this candle and to here, we have another imbalance here. We have another imbalance here. As you can see, we have another one here, and immediately price went up to fulfill this imbalance. What happened? Price went down a little bit, go up, sweep this high, and went down again. Now after that, despite that, price still pull back at this point again to fulfill this imbalance here. And how can you trade this in this kind of situation in the market? So this is what I'm going to show you how you can trade this. Let's just get rid of this, or let me just leave it. So how you can trade this, immediate price comes to your imbalance to fulfill your imbalance. Now the first thing you need to do is to wait. You wait for price to either fulfill it or just price to mitigate it and close back into your direction. Maybe you are looking to maybe in a bearish move. As you can see, we are in a bearish move and we are looking to sell, so you need to wait for price to fulfill the imbalance. As you can see, we wait as price moving, fulfilling the imbalance. Price is heading back towards the downside. Then immediately price went to fulfill your imbalance. You can either wait for price to close back below the 50% level, because you can see this line that I draw. Let me just take this out. Let me just get rid of this and this. Look at this line at the middle of the imbalance. This is the 50% level of the imbalance. Yeah, it's at the middle. So this line, the reason why I put the line there is that I also use it for entry. So anytime I see price fulfilling the imbalance on a chart and price is going back, heading down to the direction I intended to open, then I wait for price to close back below the 50% level of my imbalance. So, and sometimes price might fulfill your imbalance completely, and price might not even fulfill it completely. Price might just come here, filled up to 70% of it, and then drop down to close back, and then continue in any direction price wants to go. So that's it. So sometimes we can fill it up, price can fill it up, and sometimes price might not fill it up. So this is what I do. I will wait for price to come into my imbalance to feed it. Then after price coming, heading towards the direction and close back below my 50% level, that is when I'm going to open. So immediately price close below the 50% level, that's when I'm going to open. As you can see, when you look at this candle, you see this candle close back below this candle. I'm talking about the candle close. I'm not talking about the wick, because when you look here, you see that price come here, mitigate this 50%, go up again, went down and mitigate this 50%, but fail to close below the 50% level of the imbalance, go back up, went down, mitigate it, failed to close below the 50%, went back up, and now come back finally to now close back below the 50% level of the imbalance. So that's when I'm going to open. So this is one of the strategies which I use to trade the imbalance. So when I want to trade it, even if I don't want to go down to the lower time frames to take entry, so I just set your target and your entry. So your target might be 1 to 2, which is very fair. You might just target maybe 1 to 2, which is very fair. Just 1 to 2, and you see within few hours price hit your TP, and you can target the 100% level. So whichever way you're cool with. So as you can see, with this simple strategy, actually it's very simple. With very simple strategy, making use of imbalance and you understanding the market structure, because the first thing you need to make sure each time you open your chart, first understand the market structure, the direction of the price, when price is going to. It's that simple. So this is how I trade the imbalance on the higher time frames without even scaling lower to the lower time frames. Sometimes when I'm trading, when I want to trade on the higher time frames, making use of the imbalance, this is the 4 hour time frames, and you can even use the same thing on the maybe on the 1 hour, on the 2 hour, 4 hour. Just make sure you are not making use of it on the lower time frames, because you have slim chances that this is going to work when you are making use of it on the lower time frames. But when you scale to the higher time frames, and let me just tell you, you have high chances that it's going to work on the higher time frames than the lower time frames. Now let's continue with price. And when you look here, you have price continue to downside, and we have another inefficiency here. we have another inefficiency here. When you take a look at this, you see price retrace from this point here, put back from this point and went down. Now if you look very well, you see that we have inefficiency here. When you look at this candle, this red candle which wicks, you can see that this green candle is an inside bar inside of this previous candle, and all the other candles we have here, they are all inside of this candle. From the low of this candle, the first candle, and to the high of this third candle, here is our imbalance. So now let's just mark this from this low to this high. So we have inefficiency here, which is 1, and when you look here, we have another inefficiency here as well, as you can see. From the low of this first candle to the high of this third candle, we have another inefficiency. Price create another gap. We have another fair value gap here, and as you can see, immediately price pull back, fulfilled this inefficiency. As you can see, price failed to fill it finish. You can see price does not fill this inefficiency finish, but in as much price come back to fill part of your inefficiency, immediately you can open the trade. And sometimes it's best price went to the 50% of your inefficiency, because sometimes the institution traps traders and pull back to mitigate your inefficiency and fail to reach the 50%, then push it down lower a little bit and later push it back up to sweep all the early sellers that sell at this point, push price to the 50% of the inefficiency and then push it back down to the downside. So sometimes it happens like that when you're making use of this strategy. So now let's continue. As you can see, immediate price fill up this inefficiency up to like maybe like 70% or so, but let me just say like 75%, and price went back down. So if you are making use of strategy, you can just open here. Immediate price went back, close below it, you can open here again, put your stops here, and maybe target your 1.618, your Fibonacci. If you've watched my previous video, you see how you can just extend your target level using the Fibonacci retracement. Take your fee from this high here to this low, which is this low that we have here. So let me just extend it to the right side, and now you can just extend your TP to this 1.618 Fibonacci level, which is here. The here can be your target. Like I said, the 100% can be your target. 127 points can be your target, and 161 points can be your target as well. If you watch my previous video, I've explained how you can extend your target as well. Check out my previous video. And when you look here again, we have another inefficiency at this point. When you look at this candle, when you look at it very clearly, you can see that this weak candle engulfs all these candles. All these candles we have here, they are all inside bar to this previous candle, this weak candle. So if we want to mark out our inefficiency, how are we going to mark it out? So we're going to mark it out from this point, from the low of this first candle here we have here, and to the high of this third candle, because this third candle break this candle, break below this second candle. All the other candles we have here are just inside bar candles. So let me just draw it back and just draw it out. As you can see, we have inefficiency here, and if you look here as well, this candle low, from this candle low to this candle here, this is the candle that broke out first outside of this long momentum candle we have here. When you draw it to the low of this third candle, we have this red short candle. As you can see, this green candle is inside bar to this long one, but this red candle break out outside of it. As you can see, break out outside of it, and you can just mark your imbalance from the low of this candle, this third candle here you have here, to the high of this third candle we have here at this point. So this becomes your imbalance in the market. So immediate price went back, fulfilled, as you can see, like I said previously. Sometimes even when price come here to your 50% point, you can see price went down, closed below the 50% point and went up again to sweep this high. You see, to sweep this high. So immediately price sweep this high, and what happened? Price went down. That's why I said sometimes price went up to pull down, to trick people to just sell, and price will go up again to grab all the liquidities before selling. And sometimes it might not even get to the 50% point. Sometimes it might be just a little bit, come to your inefficiency point a little bit, come down, sweep it, then go lower. So that's the reason why you need to be smart when you're trying this kind of strategy that I'm showing. So immediately price come here, you wait for price to close below it. So price getting to our 50% level, then you put your entry here. And now if you want to put your stops, make sure your stop is at the beginning of your inefficiency, because sometimes the institution manipulate price and took out the early sellers or buyers in the price in the market. So make sure you're putting your stops at the right point, like we have here. So if you put your stops here at the beginning of this inefficiency, your stop will definitely not be it. Then you put your target here. As you can see, this is a nice risk to reward even when you take this trade, as you can see. So price just fulfilled, price just went back up, grabbed this high. Similarly, price grabbed this high, fulfilled more of the inefficiency and went down to the downside to this low. And we have another break of structure here, price break structure here. So when you look here, you see after price went down breaking the structure, we have another inefficiency at this point, as you can see, from the low of this candle, to the high of this third candle that broke out outside of this momentum candle. As you can see, this momentum candle engulfs all these candles that we have here. All these are inside bar candles. They are all inside bar to these momentum candles. So this point from here to the low of this candle that broke outside of this momentum candle, we have inefficiency, as you can see. So price going back up to the above the 50% level of the inefficiency and close below it. And sometimes if you are not careful, and maybe you just focus on this kind of strategy, your stop is going to be at this point. Let me just see, immediately you see price close below this level, and then you put your stops here and set your target at this low. Let me just say you set your target here. So price is definitely going to hit your stops. So there are other things you need to put in place. So these are part of the things I teach in my mentorship class. So to be part of the mentorship class, you see the link to my Telegram channel in the link in the description of this video rather. So you send to the link to my Telegram channel and even my Telegram inbox, where you can send me a DM if you want to be part of my mentorship class, or if you want to grab my course, which I already explained everything you need to know about Forex, my strategy, how I exit trade, how I enter trade, and everything I know. I've shared it in the course. And if you want to grab it, just send me a DM on Telegram. So now if you continue from here, you see price hit our stops here. Let's say we have our stops being hit at this point. Yeah, so we have our stop being hit at this point, but we have a winning trade at this point. I think we have our first winning trade here, and we have another winning trade here at this point here, which is second. Now let's continue playing price for. So price went up again, come to this inefficiency we have here, because this inefficiency has not yet even been filled. As you can see, this inefficiency is not yet been filled. So price went into the second inefficiency we have here that's not yet been filled. This one has already been filled. We have nothing to do with this anymore. Price has already come inside of it, filled up to the 50% level of the inefficiency. So we can make use. Immediately price filled up to 50% level of your inefficiency and went down, give you some profit, then you are not going to make use of it anymore. So get rid of it. So let's just get rid of that. So now when you look at this, this one here, price went back into the previous inefficiency we have here, and after mitigating it, and you can see we also have a supply level at this point. But that's not what I want to talk about in this video. So after fulfilling the inefficiency, after fulfilling the inefficiency we have here, price went back down, closed below the 50% inefficiency. So immediately price closed below it, then you can open on this trade, or you can just open on this trade. Immediately price closed below it, then put your stops maybe at the eye, at this eye. Then you set your target. Your target might be the 100% level or the 1618 Fibonacci level. So as you can see here, you can set your target here. As you can see, this is just you making use of the inefficiency. As you can see, it's very simple. So remember, we are making use of this on the higher time frames. Remember, not lower time frames, the higher time frames. Now let's continue. So let's say we have another winning trade here using the simple strategy, the inefficiency, this inefficiency, using the inefficiency, simple strategy. Now let's continue. Price has fulfilled everything we have here. This inefficiency here, if you look at the inefficiency we have here, has been fulfilled. Now the only inefficiency we have here, let's see. Price closed below it, went back to fulfill this inefficiency. It has even fulfilled it up onto the 50% level. So if you want to, you can also make use of this as an additional trade entry at this point. So if you make use of it, you can have an additional trade entry at this point, because you see immediate price went back, closed below the 50% level. You can just open, put your stop loss at this point, because you can see at this high, from this high to the low of this third candle that we have here, we have gap. Let's first get rid of this. From the low of this first candle to the high of this third candle we have here, we have price creating inefficiency, we have gaps. So immediately price went up again up to the 50% level and closed back below it. Then you can have your entry and put your stop loss at the high or at the beginning of the inefficiency and set your target. You can see, if you are making use of this strategy, you have another entry here at this point. Also we have another entry here. So now let's just continue, and if you look here, you can see here again we have another inefficiency at this point again. From the low of this candle to the high of this third candle, we have another inefficiency. From here to here, you can see from this low of the first candle to the third of this, to the low of this third candle, we have another inefficiency at this point. So now so immediately price come back to mitigate the inefficiency and went down. As you can see here, price did not get to the 50% level of inefficiency. So sometimes when you see price coming into your inefficiency level and you now have shrinking candles without reaching the 50% level, so sometimes it's a trap. So you need to wait for price to come to the 50% level of your inefficiency and close back, then you have your entry. And even if you want to trade this way, then you can just put your stop loss maybe at the high, so that you'll be at the safer side, but you'll be having a large stops. So your stop loss is going to be very big. So it's better you wait for the high confirmation before you open on the trade. So as you can see here, we have price pullback, took out the early sellers here at this point. So immediately price took out the early sellers here, went on to the 50% level of the inefficiency. So immediately price closed back. When you look here, you see price went in, went down, rejected, failed to close back below the 50%, go up, and even this green candle did not close below, because a bullish candle opens at the bottom and closes at the top. This green candle closed at the top, but when you look at this red candle, opens at the top and close below the 50% level of the imbalance, then you open and you now put your stops here at the beginning of the imbalance we have here. Then you set your target to the, it can be the 100% level or the 1618 or Fibonacci level. Then you set your target. You can see, using a simple strategy, making use of this simple strategy using your imbalance. So this is a very simple strategy you can make use of when you are trading on the higher time frames. Remember, higher time frames, not lower time frames. Now let's continue and place price forward. When you look here, we have another winning trade here. Let me just drag it to the side. And now when you look here, we have even up to 2 imbalances here. When you look at this candle, this doji candle, you see that this candle engulfs all these 3 candles. They are all inside bar to this previous candle. So this level is not so from the low of this candle, you now spot your imbalance from the low of this candle to the high of this third candle. So all these candles are just inside bar candle, so we are not making use of it. So when you spot it out, then you drag it to the side, and we have another inefficiency again. As you can see, price failed to fulfill this inefficiency and continues the downside. So now let's spot another inefficiency from the low of this first candle to the high of this third candle that broke outside of this large momentum candle, which is the second candle. Then let's spot it out. You see, from the low of this candle to the high of this third candle. Now let's drag it to the side. As you can see, so immediately price broke the structure, hitting our TP. Price went back to the 50% level of this first inefficiency we have here, as you can see. But when you look here, you see that we have another inefficiency even here at this point. So don't let me just overlook this. When you see here, we have another price pullback here before breaking the structure, or let me just say before breaking this low, because we have no liquidity grab. Here. If you haven't watched my previous video, make sure you watch it to understand how to mark structures. So from this low, from the low of this candle to the high of this third candle, we have inefficiency here also. So immediately price coming into this inefficiency, price retrace from this point, and as you can see, even here we have another inefficiency. Even here, the low of this candle to the high of this third candle we have here. But the reason why it's not advisable to sell at this point, because you see price is being oversold at this point. So we have high chances immediately price break this low, we have high chances that price is going to reverse back. So that's the reason why you can't even sell at this point. Even if you have a confirmation, it's not advisable. So you either wait for price to get to your extreme point in the market, maybe your extreme point when you take your fib. Let's take our fib from this point to this point, maybe starting from your 50% level of your Fibonacci level. Starting from 50% level, price fulfilled this inefficiency, went up, fulfilled this, and went to the one we have at the extreme point here. As you can see, we are now above the 50% Fibonacci level here. When you take out your fib, as you can see, we are now above the 50%. We are at a discounted price, at the discounted point in market now. So at this discount point, then we can now start looking for our trade entries. So now when you look here, and you remember I said that you can make use of imbalance as the only confluence to take your trading decisions. It's just an additional confluence for you to use. So immediately price went to the 50% level of the inefficiency and went back down to close below it, then you can take your entry. As you can see, this green candle mitigate the 50% level we have here, this green bar, this green line, up onto the 50% level and went down to close below it. Then you can take your entry and put your stops at this high of the imbalance. Then set your target, maybe the 100% level or 1618, your Fibonacci level. And you can see even at this point, price just continues to downside, keep on going, tanging to the downside. Wow, Wow. So we have a very huge move at this point in price, and we have like about 400p plus, like 400p plus, as you can see. So this simple strategy, which is using just your imbalance and entry at the 50% level of your imbalance on the high time frames. We have a lot of strategy in Forex. So making use of this simple strategy, we have how many winning trades? We have about 1, 2, 3, 4, 5, 6. 6 winning trades, and we have only 1 loss. So we have only 1 loss, and we have 6 winning trades. When you are someone who trades on the high time frames, so this strategy is something you can make use of. So you can just make use of this to trade your to trade on the high time frames. And there are other additional confluence to this. When price gets to your inefficiency of the high time frames, then you can scale lower to the lower time frames to look for your confirmations, because sometimes, like I said, like what happens here, sometimes price might not continue like you want, and price will just go against you, hit your stop loss, and you're out of the trade. So this is the reason why we scale to the lower time frames for entry confirmations, which I share in my mentorship class, and I also have made a video about it in my course. So you can either join the mentorship class or grab my course, which I already made. To grab this, to have an access to this, just send me a DM on Telegram or join my Telegram channel. You see the link to my Telegram DM in the description of this video. And also the broker that I use that I would like to recommend to you, because most traders don't know which broker to trust and which broker to make use of. So you see the link to the broker I use also in the description of this video. And also the prop firm that I use, you see the link to the prop firm that I use in the description of this video. So if you learned something new today, make sure you hit the subscribe button, subscribe to my channel, and turn on the notification icon so you miss out all my future updates. To watch the next episode of this video, you see the video popping up right now in the top right corner of your screen. Click it to watch the next episode. Until the next, peace out.